Today we're going to talk about how does an IUL work. And we're going to go over it very simply. Here we have Jill. Jill can be anybody. She can be you, she can be me, she can be anybody, but today she's going to be you. Jill has a job and she earns income, and she is going to put a portion of her income, let's say $1,000 a month, into a contract with an insurance company called an indexed universal life insurance policy. So she puts this $1,000 a month into the insurance policy, and a small portion of that money goes to an immediate death benefit. So if something happens to Jill, she should die of a heart attack or something, her family would be covered and receive a death benefit. If she should get disabled or get cancer or something like that, she actually would have access to that money while she was still living. But in any case, a small portion of the money going into the policy does go to cover the death benefit. The rest of the money, the vast majority of the money, goes into an accumulation account that is earning interest based on a market index. The average over the last 10 years been about 7 to 10%, and because the money is not invested in the index but is instead just tied to the market index, the account will never be exposed to market volatility, and it can never lose money based on the market index. Based on a market is going to just continue to gain interest over the years. And as that gains interest, it becomes more and more available in the cash value account, which is like Jill's bank. This is the money that Jill has access to throughout her life. She doesn't have to wait till she's 59 and a half, like Mary, who bought a 401k. But instead, she can access the money. And rather than draw the money out, she is going to take out tax-free loans from the insurance company. She would go to the insurance company and say, I have this much money in my cash value. Please use that to collateralize a loan for me. And they are happy to do that. And they say, we know if anything happens to you, we will take the money from the cash value in your account. So they were happy to send the money over to her. She can spend the money, but her accumulation account never goes down. It continues to gain interest at the same rate, the same amount of money continuing to grow, because that money has come from the insurance company instead of out of her cash value. And if Jill decided that she wanted to pay the money back, she could pay that money back, and it would become available again in the cash value account, and then she can borrow it again. So she can access that money throughout her life. And it's tax-free income. If you have interest in setting up an IUL, we'd love to meet with you and see how one of these can work for you.